Good morning and welcome to Financial Strategies with Scott Wardell. While various products may be discussed during the course of this program, please note that these discussions are intended only to educate you about financial topics. They are broad in scope and do not consider your individual personal financial situation. You should work with a qualified financial professional in collaboration with your attorney and tax advisor before implementing any financial decisions which will affect your personal financial situation. Thrivent financial representatives cannot provide legal or tax advice. Your local Thrivent representatives are Wayne Grunkley and Alan Sogstead, 215 Atlantic Avenue, Morris. Call 589-1731. And now, Financial Strategies with Scott Wardell.
It's time for Financial Strategies with Scott Wardell, and boy, oh boy, what a week. And I'm a sports fan myself, watch the World Series. We were just joking about it.
Absolutely.
About World Series and what that might mean for the markets.
Right.
Tongue in cheek, of course.
I was actually more interested in those past theories about hemlines,
Hemlines?
Because the old theory wasn't it when the hemlines went up, it was good for the market. When they went down, it was bad for the market. Whatever.
That sounds good.
All those, yeah, it sounds good. All of those different theories, exactly. So, yeah. So, wow, great week on the market, and I've been excited for this week's show because I have Russ Swanson, who's the Chief Investment Officer from Thrivent Investment Management, with us here today. So we've got a great show coming up for folks where we're going to be talking about the markets. Russ is also going to give us a little bit of relaying his story on a recent trip to China, which I think people are going to be very, very interested in. And we're going to talk about, well, what do people do with all this economic information? If they've been listening at all this last week, they're certainly hearing about, what's been going on with the European Union and with Greece, and certainly some relationship to how that's given the market a little bit more confidence. And
sounds like everything's okay over there, at least right now.
Well,
to a certain extent.
Yeah, exactly. I think what the market likes is that they're moving in the right direction more than anything. But we're going to talk a little bit about that today. So we got some really good stuff. Russ has got really 30 years in the investment management business. He is the Chief Investment Officer of Thrivent since 2004. Manages $75 billion in assets through his team, so it's a pretty big sum of money.
It's a couple dollars more than what I normally do.
Yeah, that's right. He's got his economics degree from Gustavus Adolphus, right down the road here at St. Peter, and a master's of business administration from the University of Minnesota. Russ, I'm just absolutely delighted to have you on the show here today, and I'm sure that we're going to talk a little bit about the market. So, we're going to shed some light. So let's talk about, first of all, the update of what the markets have been doing so far this year. We've got 10 months, because we're at almost the last day of the month here at Halloween. Give us a little update on the performance, if you would.
Sure. Well, it's great to be back, Scott. Thanks for having me on the show again. This year has been a rocky one for the stock market. But before I talk about that and give you some numbers, let's talk about interest rates, because there's been a lot of change there as well. Short-term interest rates have been held close to zero now, really, for about 3 years, and that held steady through this year as well. Anybody who has money in a money market fund will know that you're earning little or nothing there. The more significant news was in bond yields, which it went down this year about 1%, regardless of whether you're talking about 10-year bonds or 30-year bonds. And so interest rates sort of across the board are at very, very low levels. So that's one thing I think to be aware of. Getting to the stock market, usually when I comment on the stock market, I like to talk about the S&P 500. This is an index of 500 large stocks, and as we all know, it's been a rocky year. But as of the close yesterday, the S&P 500 was up a little more than 2%. For the year. And
for the year, and almost, well, I mean, if we go back to Thursday, it almost, I mean, we started at break even, and this has been a good week.
Yep, that's right. And the Sort of the low point of the year was during August, September, and we're up, 16, 17%, or roughly in that area from then.
And isn't that usually atypical? Isn't August, September for the markets? Isn't that normally a time that they're doing better than normal?
Well, I think October has been historically one of the worst months in the market, and turned out to be really a very, very good month.
Because Black Tuesday happened, was it on this day? Was it on the 28th? Or it's...
I mean 1987?
Yeah.
Yeah, 1987, I think it was on the 21st,
okay.
But towards the end of October.
Sorry.
Yeah, I keep track of it only because it was right next to my mother's birthday.
I'm sure.
But yeah, exactly.
Well, so let me also shed a little bit more light on some of the fundamentals underpinning the fortunes of companies in the S&P 500. Let's talk about earnings. We know that economic growth has been a little bit slow this year, but earnings growth in the S&P 500 have been very good. So let me talk about growth for the first 3 quarters. In the first quarter, net income for the S&P 500 was up 15% over the prior year.
Wow.
These numbers may come as a surprise when we think about some of the other economic statistics that we see so frequently. Excuse me, I said 15% for the first quarter. It was the 15% was for the second quarter. It was net income grew over 17% in the first quarter. So 17% in the first quarter, 15% in the second quarter. We have about 60% of the companies in the S&P 500 reporting for the third quarter.
Yeah.
So a little more than half.
Yeah.
And it looks so far like net income for those companies is up 18% over the prior year. So a lot of very strong earnings growth within the S&P 500.
Well, and that's great news. And on top of that, of course, this last week there's been a lot of talk about GDP being up, reported from the previous quarter, now corrected, I guess, at about 2.5%. And I know that's not what we're hoping for more than that, but that's also very positive, and that's kind of where these numbers lift up to, right?
Yep. And they call that the advanced release. They have an early estimate, if you will, of GDP for the third quarter was up at an annual rate of 2.5%, was what's much better than the first half of the year. The first half of the year was actually a growth rate of less than 1%. Now we'd like to see growth. Regular steady growth is around 3%.
Right.
So 2.5% is even below kind of the normal rate. And we still have yet to catch up after the recession. So really we should be hoping to see something like 4.5%, for about 4 years running in order just to catch up. So 2.5% certainly is better than a recession that everybody was worried about.
Right.
But, it's not really what we should be expecting to see.
And when you say what everybody was worried about, because the talk was the double dip.
That's right.
And I know that, there's always odds that are being thrown out there on the double dip. And this last week, a lot of people are saying that the odds of a double dip have gone down pretty substantially.
Yes, I'd agree with that. I think that they were maybe 50-50 in the middle of the summer. I think the odds have diminished significantly. We're talking about probabilities, so the probability is never zero.
Right.
But, it's a lot less than it was like I say, in the summertime.
Yeah, okay, good. And speaking of the summertime, last time, Russ, that you were on the show, we were talking about the deficit and the deficit ceiling, and Congress was right about to hit their deadline.
Yep.
And, of course, I think the public's view and investors' view of the markets, we were lacking a lot of confidence because our government couldn't come to any decision. And frankly, a lot of the volatility we faced came around that time and right after that time.
That's right.
And so now we're at a point, because as you well know, that they appointed this deficit super committee or something termed like that.
Yeah, we refer to it as the super committee.
The super committee, yeah. So the super committee, is supposed to come up with, some recommendations for how we're going to get this deficit under control. So update us a little bit on not only what that is, but also what effect it might have on investors in the markets, because last time it really threw us into a spin.
Well, I'm glad you asked me about that, because I think people have, a lot of people have kind of put that issue out of their minds, and we have not yet solved the deficit problem. Just to remind people, the whole issue around that point in time was that we were going to hit the debt ceiling limit,
right.
And they wanted to raise it. There were members of Congress who didn't want to raise it unless we could get a commitment to reduce the deficit in the future. There were cuts at that time that were agreed to of about $900 billion.
Yep.
And then this super committee of 12 Congress people.
6 from each party.
6 from each party, and 6 from the Senate and 6 from the House.
Okay.
Was formed, and their charge was to come up with a recommendation to cut another $1.5 trillion, actually a minimum of $1.2 trillion, and to make that proposal by Thanksgiving. And then the Congress was supposed to vote on it, between then and sort of before Christmas time, if
Sure.
you will.
Sure.
And so they've been kind of working on that. A lot of the meetings that they've had, I would argue, most of the substantive ones that they've had have been closed-door meetings, so we don't really know kind of what kind of progress that they're making. There's a lot of speculation. There are rumors. I will say that I'm not confident that they're going to come up with the minimum of the 1.2.
Right.
Kind of best guesses right now are maybe half that number,
right.
Maybe 600, maybe 800 billion. If that happens, I think it could create, another, it'll agitate some news. It'll agitate a lot of political rhetoric. There is this thing called sequestration that will happen. What that means is that there are automatic cuts that happen, but they don't take effect until January of 2013.
Okay.
So what that means is that, they have really more than a year to argue about it some more.
Okay.
Before the sort of forced cuts happen. And a lot of those forced cuts are to defense. And even President Obama's Defense Secretary, Leon Panetta, thinks that the numbers in this automatic cutting, the sequestration, would be catastrophic for national defense. So it's going to create a lot of pressure. The rhetoric is going to ramp up, and so people should, I think, be prepared for for that issue to sort of boil over again, if you will, in the future.
Okay, so when you say boil over, last time, of course, we had a period of time where if they didn't do something, there was parts of the government that needed to shut down. Of course, here sitting in Minnesota, we saw that earlier in the year with our own state. But this is not set up to be quite as dramatic or catastrophic as that, correct?
Yes. Actually, I'm glad you asked me about that, because I meant to comment on it. The last time, the thing that forced the debate was the need to raise the borrowing limit, the debt ceiling. As part of the deal that was agreed, there are provisions that the debt ceiling can get raised in increments, and there's some fancy legislation around it, but the bottom line is they can raise it in increments enough that really will get us past the next election.
Okay.
So while there will be a lot of arguing about this, I think, we're not going to face the same panic that we had last time about the debt ceiling. And it's, the thing that's critical about the debt ceiling is we're actually borrowing about 40 cents on every dollar that we're spending right now. So we need to be able to borrow that money, or we're forced to make cuts.
Right, right. And eventually, of course, we need to figure out how to get this whole situation balanced. So the
Absolutely.
long-term view is not that good. Okay, so Russ, thanks for laying the groundwork here, and we're going to come back in a minute, and Russ is going to tell us a little bit about his view of what the markets look like for the rest of the year and a little bit into next year. So hang on so you can hear a little bit more of Russ Swanson and some of his thoughts about where we might be headed.
How would your financial life improve if you changed just one thing? Avoid ATM fees, make your gifts rather than buy them, protect yourself from identity theft, save more for your family's future. The list goes on. If you heard something today on financial strategies that motivates you to change one thing in your life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one thing. Think about your finances, your lifestyle, your wants versus your needs. What one thing can you change today and see the impact tomorrow? Perhaps your family will save all your change for a month and donate it to charity. Maybe you'll finally write a will. Whether you choose to start simple or take a big step, that one thing can really make a difference. If you heard something today on financial strategies that motivates you to change one thing in your financial life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one thing.
And we're back with Financial Strategies with Scott Wardell. Our guest this week, just a ho-hum guy, Russ Swanson, the Chief Investment Officer at Thrivent Investment Management.
Am I boring you guys?
No. He says that because whenever I say to him $75 billion, he just about falls off his chair. So from Adam's point of view, that's pretty exciting stuff, and I'd have to agree. And Russ, we've been talking about this super committee. We've been talking about the deficit. Let's really switch gears a little tiny bit here and talk about the markets. As you said here a moment ago, that we're up about 2% for the year right now. And we've got some issues. We've got some things that have gone well with European Union. What do you see for the rest of the year relative to the markets? And take us a little bit into next year as well.
Sure. Well, when we started, I started by talking about interest rates, and I think that what we'll see there is that interest rates, the Fed has already said they expect to hold short rates where they are until into 2013. So I expect those to stay where they are, basically zero, for the rest of this year certainly, and through next year, and likely into 2013. Bond rates are also low, and I would expect them to stay low. At some point they have to rise because really I would argue they're too low. And
Sure.
and so let me explain why I think that a little bit. Inflation, depending on how you measure it, lately has been running about between 2 and 4%, as I say, depending on how you measure it. So if you're only earning 2%
Yep.
or 4% on your bond investments, you're not really earning a real return. You're
Right.
just staying even with inflation. And normally interest rates offer a return above inflation.
Sure.
And I think that, we sort of hope that inflation stays in that 2% kind of range. That's where the Fed would like it to be. If they're successful, that really says that interest rates should be higher than they are now, and undoubtedly at some point they will have to go higher. The thing to know about that is that when interest rates go higher, if you own bonds, then the values decline. So
Right.
a lot of people view those as low-risk investments, but the values there can fluctuate as well. They can go up when rates drop, and they can go down when rates increase.
Right.
In terms of the stock market, at the beginning of this year, we were expecting sort of, call it high single-digit returns, maybe 8% for the year. Of course, it's always very difficult to predict these things with any precision.
Right.
As I said earlier, at this point, we are up 2% on the year. I think it's still possible we could get to the in the 8% range. That means a little bit more from here. Again, short-term predictions are difficult, particularly when you have markets that are as volatile as they have been. I mentioned that, corporate earnings have been growing in a pretty healthy way.
Right.
We would expect corporate earnings next year to continue to grow, probably not at the same pace that we have been seeing this year or in the last couple of years, but enough to give us, again, call it high single-digit returns in the stock market next year.
Okay. High single-digit returns would please a lot of people if that would happen. But as I know, and as you know, so many variables are out there. So, for instance, this last week, what a demonstration of variables. Because the European Union folks were able to make a little progress, the market goes up. Well, how do you predict that? How do you predict,
It's very difficult. Would you like me to talk a little bit about the situation in Europe?
Yeah,
and
great.
kind of what
That'd be
is?
wonderful.
It's very hard to understand what's happening over there from the news.
Sure.
So let me take a few minutes just to try to, simplify the problem a minute, or get kind of to the root of what the issue is there.
That'd be great.
A lot of the attention gets focused on Greece,
Mm-hmm.
and only because Greece is sort of the worst of the lot
Right.
over there.
Right.
Greece has a very weak economy. They have very big deficits. They have borrowed a tremendous amount of money, and I think that there was, for a while, people weren't realistic about whether Greece was really going to be able to pay back that debt. They kept thinking that Greece would be able to repay it.
Right.
The real issue, and let me say that there are a handful of other countries that that kind of get lumped together with Greece in terms of being problematic. They're Portugal, Italy, Ireland, Spain, and Greece.
Yep.
And Greece is a tiny one, but as I said, they're the kind of the worst case, right?
Sure.
In fact, just to put a little dimension on it, Greece's population is only 11 million people, compared to 300 million people in the United States, roughly. And its economy is about the size of Maryland's. So you wonder, well, how can that little place,
Right.
create such havoc? Well, it's because it's indicative of these other countries, and some of them are not small, like Spain and Italy are larger shares of the European economy. Their situation isn't quite as bad. For example, Spain's debt to their size of their economy is roughly comparable to the U.S., but their economy is much, much weaker. Unemployment there is over 20% now.
Wow.
So, we're unhappy with unemployment in the sort of 9%
Nines, yeah,
range.
exactly.
Theirs is over 20%. So, very stressed economies in some of these places. Now, the real issue is that that the debt of these countries is owned by a lot of European banks.
Yep.
That's who owns it. And what they're really worried about is a banking crisis,
Yep.
right?
That's why the comparison to Shearson,
To
Lehman, I'm sorry, not Shearson, Lehman, right.
That's right. So for a long time, for example, a year ago, they did these bank stress tests. But when they did them, they assumed that none of these countries like Greece were going to default on the debt. I think they were unrealistic, right?
Sure.
And the market didn't believe it either.
Mm-hmm.
And so there's been this cloud over Europe for a long time, and I think investors have been disappointed at the lack of sort of realism on the part of politicians and policymakers in Europe. Well, now, they finally, I think, come to, they've acknowledged that Greece isn't going to pay back the debt. The debate is, so how much of a haircut is it going to be? And there's an acknowledgement that they have to put the banks need more capital.
Right.
And the real argument right now is who's going to put the capital into the banks?
Yeah.
Are the banks going to have to go to private investors? Are the countries themselves, like France, going to have to put the capital
Or Germany,
into the
yeah.
French banks? Or is it some sort of collective group of the European
sure.
Union who's going to put it in?
Yep.
And when they start talking about the European Union, that's when it gets difficult. We've all witnessed how difficult it is to deal with this issue in the U.S., where our economy's in better shape, our debt situation's not quite as bad. But we saw what happened. We just talked a little bit ago about the debt ceiling crisis,
Absolutely.
and we saw how bad that was. Well, the situation in Europe, the economic and debt situation is worse, and the political challenge in addressing it is vastly more complicated than it is here.
Of course.
Because you're now trying to get, there's 27 countries in the European Union, and try to get 27 countries to agree on anything, right? And some of them have actually managed their financial affairs responsibly. So, and You can have little countries like Finland or Slovakia who, have done the right thing.
Right.
And they don't want to chip in
Right.
to help Greece, who they view as having managed irresponsibly, and that's kind of understandable, particularly when you think about a country like Slovakia that is actually poorer than Greece, and now they're being asked to kind of chip in, to bail out, Greece or the banks.
Sure.
Or Germany, for example, that's a big country. And where the challenges with their banks are less than the challenges with the French banks. And now you're talking about, some old animosities there. The Germans really don't want to bail out the French banks, right? And so they all end up in this gigantic argument about, kind of who's going to provide the money. The good thing is they've acknowledged the problem, right?
Yeah.
The banks need more capital. And now the whole argument is, well, who's going to put it in?
Right.
And I think, if there is, good news in all of this, one is that you can't solve a problem till you acknowledge it.
Yep.
They're acknowledging the problem, and nobody wants to. They're all very, very concerned about reliving the Lehman experience.
Right.
Right. So, when push comes to shove, I think they will find a solution to this. But it's going to be politically messy.
Right.
There's no question about that.
And they don't have the same type they don't have two political systems. There's a whole lot of different groups in all those different countries.
Yeah.
So I mean, you're talking about a hydra with a lot of heads that are going a whole lot of different ways.
Yeah, very true.
Absolutely.
Yeah, that's very true. So that's kind of a good picture for us to take a look at, and it seems like they're moving in the right direction. But having said that, the way our media works is that any little point that it starts to fall apart a bit, and most of these agreements do have a period of time where they get work done and then go backwards a bit, it's probably going to affect the markets.
Yeah, it's up and down every day. They agree, they don't agree, and of course the media likes to focus on, the unfortunate bits, right? Which is why Greece gets so much attention.
Sure.
Because it's such a bad example. Or its problems are more chronic than almost everywhere else. And of course, protests in the street make
Absolutely.
For good news stories.
Right. So let's go back, Russ, to our markets here. If you take a look at the fact we're up, 2% or so for the year. The market seems a little stronger, especially these last 3-4 weeks have been really quite good. Is there any part of the markets that you feel are currently overpriced that people should start to avoid, and are there parts that are underpriced that they should start to look at right now?
Well, that's a good question. I talked earlier about bonds. One of the things I'm worried about with bonds is that the rates are so low, and it creates a dilemma for people.
Sure.
It's if your risk tolerance is low and you want to be conservative. Well, the conservative alternatives, money market funds or bonds.
Or CDs as an example, which I was with a client yesterday who told me that they had called their bank the week before about renewing a CD and they could get 1.2%, and they called this week, it was down to 0.9. So they'd, on a 1-year CD, they've dropped at below 1%. So this is really, you talk about the crisis in interest rates. If you are retired and you're living on fixed interest, and 4 or 5 years ago you were getting 5%, and today you're getting less than 1%,
right.
Your income has dropped like a rock.
And sad to say, but that 1% is probably a good rate. But unfortunately, it's below the inflation rate. So
way below now.
You're actually losing money there.
Yeah. Okay. So let's talk a little bit in a minute about. We're going to take a quick break, and we'll come back and talk about the parts of the market that might be undervalued, if there are any.
Yeah. Okay.
Okay, and hopefully help the people who are looking for good investments to direct them in a particular direction. Thanks so much.
You're listening to Financial Strategies with Scott Wardell. Our guest this week, Russ Swanson. We'll be back with more right after this.
Nearly 3 million members look to Thrivent Financial for Lutherans to help them achieve their financial goal. Nearly 3 million people know that Thrivent Financial is committed to excellence in financial services and caring for others. Get to know Thrivent Financial and the quality of products and services they can offer you. In Minnesota, you have a host of representatives to help you with your financial needs. Contact your local Thrivent representatives Wayne Grunkley and Alan Sogstead, 215 Atlantic Avenue, Morris. Call 589-1731 or call 1-855-346-4332. Registered representatives for securities offered through Thrivent Investment Management Incorporated, member FINRA and SIPC.
Welcome back, everyone. You're listening to Financial Strategies with Scott Wardell. And before we continue on talking with Russ Swanson, just a little-known chief investment officer from Thrivent Investment Management. He handles a couple of dollars here or there, I hear. But before we move on, let's talk about the deal of the day for today, Scott.
Yeah, absolutely. We'd like people to call in and get this because we're talking about a lot of details about various markets, some of the part of the situation in Europe, our deficit problem here in the U.S., but really what's it all about? It's about preparing for your financial goals. And frankly, for most people, the biggest financial goal is retirement. So today's giveaway is managing your retirement savings to provide a lifetime of income. I've had this as our giveaway on several shows, and the reason is it's a pretty meaty piece. Where, sometimes, these booklets are put together and you're like, yeah, it's a nice booklet, but I don't see the meat in it. This one's got a lot of meat in it. So if you call that number, 1-855-346-4332, and just give us, put down your name and your address, and we'll mail it out to you. It's very helpful if we have a phone number as well, because sometimes we have to double check the address, make sure we get the zip code and everything's right. But call that number. It's managing your retirement savings to provide a lifetime of income. All you really have to do is say, I'd like to have a copy of today's free offer, and we'll get it out for you. The other thing I want to mention is that we do have a series of seminars that are going on in the area. So if people want more information, they'd like to sit down and see a presentation, ask some questions firsthand, they can go to Thrivent.com, and on Thrivent.com you just type in find an event, and it will give you all the events listed. And you're going to find you have to click on your state, and most of our listeners are in the state of Minnesota, but you click on your state and it'll show you the events for the state of Minnesota. And of course, I've got a couple myself coming up. We've got one this coming Tuesday on November the 1st at Fong's Restaurant in Prior Lake, and that is very much about retirement planning. So if people have been listening to the show and they say, hey, I'd like to get into the meat of retirement planning a little bit more, then you can go on to Thrivent.com, find an event, and you can register right there online. So I encourage people to use that as well. You can also call that 1-855 number if they prefer not to go online, but there's all sorts of events in your areas that are listed on Thrivent.com, and then you type in find an event.
So a good website they can use to check it out.
To check it out anytime they want. It's a great little website. So Russ, before the break, and I have Russ Swanson with me, Chief Investment Officer for Thrivent Financial. Before the break, we were talking about bonds and interest rates, and before that, we were talking about corporate earnings. And as we were talking about corporate earnings and being very, very positive, when is hiring going to start to happen? I mean, people they see the markets are going up, but they look around them and, they might be unemployed, or their brother might be unemployed, their wife might be unemployed. When is that going to change for us?
Well, that's a good question, Scott, and people ask me that from time to time. I think that one of the things that folks, because these corporations are very, very large, I think it's easy to view them as being a much larger share of the economy and employment than they actually are.
Sure.
A lot of people work for small companies that are not the big corporations like the S&P 500.
About half of our workforce, right?
Yes.
Somewhere in that neighborhood.
Somewhere in that neighborhood.
Yeah.
And all of the net job growth, when you look at aggregate numbers, right, in the economy, all the net job growth comes from small companies, not the big corporations.
Yep.
And so even though the corporations are doing well, and you would think that that would have, one, that would be representative of the larger economy and it would be driving, it would have a significant effect on employment. The fact of the matter is that it's small companies that drive employment growth.
Sure.
And there, things are more difficult there. Small companies are most of their earnings come domestically. One of the things, take the S&P 500, 40% of the earnings of the S&P 500 come from overseas. The biggest share Europe, the next biggest share in Asia. But for small companies, most of those earnings come domestically. And so issues like the deficit and how that's going to get solved, and does it mean higher taxes, issues like healthcare reform, and is that going to increase the healthcare costs of their employees, weigh very significantly on small employers.
Absolutely.
And they're not sure how that's going to work out, and uncertainty is the same thing as risk. So small employers are really hunkered down right now, and I think that's where the disconnect is between the employment situation and what you see with when you think of corporations.
Absolutely. And, because I have a number of clients who are small business owners, I keep my ear to the rail on this one pretty closely. And I'm hearing more good news in this last quarter than I've heard for a long time, where their businesses are starting to look more and more optimistic. But use the term, Russ, hunker down, and I think that they've kind of got to get over this nervousness that they've been carrying around with themselves, because a couple of the business owners I work with, they've got their people on double shifts or a time and a half kinds of shifts, because they thought, I'd rather work the people I've got a little bit longer than to hire on some new staff. But they're at the point now, many of them, where they're really going to have to start to do some hiring. So from what I'm hearing now, small sample set,
Yep.
small sample sets, things are starting to sound a lot more positive. Well, Russ, I want to do a quick transition for us here, but as you're talking about the equity markets here, from what you said from hiring, to just say a word about that, and then I really want to talk a little bit about your trip to China.
Sure. Well, you asked me earlier about what parts of the market we like, and I commented on bonds and
Yes.
my concerns there and explained that. And there's really kind of a dilemma, and that is if you're a conservative investor, it's very, very hard. And there's no question that there are a lot of challenges and uncertainty in the market today. When I get to talking about the stock market, though, here's some interesting facts. We talked about how strong the earnings growth has been.
Yep.
And I'm just going to make a little comparison between large company stocks and small company stocks. If you look at the S&P 500, which we've talked about a lot today, the price to earnings, the PE ratio,
right,
which is a measure that is frequently used when we talk about how expensive the market is.
Valuation.
The PE on the S&P 500 is about 13.6 today.
Okay.
For the 100 largest companies in the S&P 500, it's about 12.5.
Mm-hmm.
So a little bit cheaper. When we talk about small corporations, still stocks that trade, but the smaller ones, and the index there is the S&P 600.
Right.
There, the PE ratio is 21 times.
Yep.
Now, the PE ratio on small stocks is usually higher than big stocks.
Sure, because it's the growth potential you're investing in.
But the relationship is one where the valuations on small stocks look a little high compared to big stocks.
Sure.
And the big stocks are the ones that are able to take advantage of the growth in places like China, for example, we'll talk about in a little while.
Right.
I'll give you another point of reference. In 2007, there was sort of a peak in the stock market. We went down, and for big companies like those in the S&P 500, we're still about 17.5% below where we were at the peak in 2007,
right,
despite all the earnings growth we talked about earlier.
Uh-huh.
For those small stocks that I talked about a moment ago, we're a little less than 5% below the peak. So we've done a lot of catching up
Okay.
in the smaller stocks. less so in the big stocks. So I would say the area that we find more attractive are big multinational companies where the earnings are good and they're able to take advantage of growth overseas, and their businesses are a little more diversified.
Very interesting. So let's use that to just real quickly start talking about your trip to China. Because you've shared a couple of really interesting things with me, because we think about investing in emerging markets as investing in companies that are domiciled in that particular country. And I think you can open the eyes of our listeners here to say, how do we take advantage of some of the growth that's happening in China? Tell us about your trip.
Sure. Well, I spent a week in China, and I visited a number of factories. I visited a hospital. I visited a medical testing company that actually has a relationship with the Mayo Clinic here in Minnesota.
No kidding.
I met with some members of the U.S. Chamber of Commerce office in China, where they work to help U.S. businesses do business in China. I met with a member of the Chinese Congress, which has almost 3,000 members to it. You might be interested to know that 30% of the Chinese Congress are not members of the Communist Party anymore.
Interesting. Interesting.
And not only that, but although they still refer to it as the Communist Party, really they are not applying communist ideology to the running of the country anymore. It's still an authoritarian government. But capitalism has really kind of taken over the country.
Sure.
Now, the government still controls about half of the economy over there, but half of it has been unleashed to entrepreneurs and to free enterprise in sort of a Chinese fashion, if you will.
Sure.
That's the sort of thing I looked at. Let me give you, it's very hard, I think, to appreciate how different it is in China when you're sort of used to what's normal here.
Right.
So let me put a little bit of perspective on how different it is. Often when economists will talk about per capita GDP.
Right.
And that's sort of how big your economy is divided by how many people you have. And our per capita GDP in the United States is about $42,000 per person.
Sure.
In China, it's about 1/7 of that.
Okay.
Relative to us, it's still quite poor.
6,000.
Yeah, it's about 6,000.
Right.
But from their perspective, many people there feel very wealthy, and the reason is because they started from such a low point.
Right. I'm not laughing because it's crazy to feel wealthy at 6,000. I'm laughing because we don't feel wealthy and we're 7 times better off in many cases.
That's right.
So it's an eye-opener.
So just to put a little more perspective on that, if you go back 30 years, the per capita GDP in China was about $300.
Wow.
So they have grown in 30 years 20 times.
Yep.
Tremendous progress, right? During that same period, per capita GDP in the United States doubled.
Yep.
Right? And so the relative rates of growth are vastly different. They still have tremendous catching up to do, but the growth rate is tremendously high.
Wow. Interesting stuff. So we're going to take a quick break here, Russ, but when we come back, I want you to tell us a little bit about the Chinese appetite for some of American goods and maybe even in some ways American services, and how we might be able to take advantage of that to help grow our economy here, and what might be a good investment for some folks.
Absolutely.
You're listening to Financial Strategies with Scott Wardell.
How would your financial life improve if you changed just one thing? Avoid ATM fees, make your gifts rather than buy them, protect yourself from identity theft, save more for your family's future. The list goes on. If you heard something today on Financial Strategies that motivates you to change one thing in your life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one thing. Think about your finances, your lifestyle, your wants versus your needs. What one thing can you change today and see the impact tomorrow? Perhaps your family will save all your change for a month and donate it to charity. Maybe you'll finally write a will. Whether you choose to start simple or take a big step, that one thing can really make a difference. If you heard something today on financial strategies that motivates you to change one thing in your financial life, Thrivent Financial for Lutherans has free tips and resources you can use to do one thing differently. Find more at thrivent.com/one-thing.
And we're back with Financial Strategies with Scott Wardell. Our guest this week, Russ Swanson, joining us and talking about a whole lot of stuff. We were talking about China before the break, in fact.
And Russ was just helping us understand where they're at on the GDP standpoint, and kind of fascinating where they're at, how fast they're growing, but also how far they have left to catch up, Russ.
Yes, and let me talk, a lot of people have recognized the growth in China and the potential growth
Right.
in China. And as you said, they'd like to invest to take advantage of that. And,
Yeah.
of course, often the natural thing is to think, well, let's invest in Chinese companies.
Yep.
Honestly, the more interesting opportunity from my perspective is investing in Western companies, U.S. companies or European companies who are selling into China. And let me give you a couple of examples
Okay, good.
that I think you might find surprising. One, I'm going to start with Kentucky Fried Chicken.
Okay.
That's a name that everybody knows. Kentucky Fried Chicken is the most popular restaurant in China. And the company that owns Kentucky Fried Chicken also owns Pizza Hut and Taco Bell and a couple of others.
Right.
That company makes 36% of its operating profits on China
Wow.
right now. So there's an everyday example of the tremendous opportunity.
And you said something earlier to me today about how many are being built, like one every so many days?
Well, I think if I recall correctly, they're opening one every 18 hours.
Every 18 hours.
Wow.
Oh my gosh.
Another thing, I was talking about some of the economic dimensions earlier, and the population of China is about 1.4 billion, so it's about 4 times the size of the United States.
Yes.
The land mass in China is about equivalent to the U.S., but only 14% of the land is arable. And the amount of land that they have that they're cultivating for food is only about 3/4 of the amount of land that we are cultivating here, with 4 times the population. And they're actually struggling to feed their people. They're having to import food.
Right.
I know many of our listeners live in farming communities, so
Yes.
that they may find that that's an interesting dimension as well. And as the country becomes wealthier there, and they can afford more food, the demand rises.
Absolutely.
And so I think there's an export opportunity for us there. There's another thing. As I say, it's hard to imagine the lack of infrastructure. I visited a hospital, and there's almost no modern medical equipment in the hospital, and so and of course they're not inventing their own medical equipment. They're buying it from companies who have already invented it
Right.
on our
A
manufacturing.
lot of U.S. companies, yeah.
A lot of U.S. companies, and I mentioned earlier the relationship with the Mayo Clinic. Another thing that surprised me, I was walking in a parking lot there, and I noticed there were a handful of Buicks parked, and I said, "Gee, look at that, a Buick in China. Who would have thunk?" And the guy I was with said, "Oh yeah, Buick was the most popular car last year
In China.
in China."
Right.
Huh?
And this year, I guess it's Audi, but I think people might find
Right.
that surprising. Other things, I'll give you one last example.
Sure.
And this is a private company. This is one of those companies that's not listed on the stock exchange like we were talking about before. And we have an investment in this U.S. company that owns and operates these big freezer warehouses for food storage when it's
Sure.
in transportation. And in China, about 40 to 50% of the food actually spoils from the farm to the table.
Huh.
So they lack the infrastructure to actually maintain the supply chain for food.
Yep.
And so this company, as I mentioned, that we have an investment in that operates these freezer warehouses, is actually building a freezer warehouse in China. So there's a lot of infrastructure spending like that and opportunities for U.S. companies, as I say, to take advantage of the growth and just the tremendous development opportunity that's there. And as I say, I think those are the more interesting opportunities.
Shocking parallel to, if you go back 30 years, the Soviet Union had exactly the same problem. It was distribution of the food. It was not production. They couldn't get the distribution and the storage of it, and so the numbers were shockingly similar to that. And I suppose you see that with a lot of developing countries as they're coming along saying, as you increase production, you got to have distribution and some of your other logistical things, like a warehouse.
Yeah, that's right.
in place.
Right. And roads. China's invested a lot of money building roads. If you go to some of the other countries over there, Vietnam, Indonesia, they have problems just transporting things. As a matter of fact, one of the interesting things is that China is no longer the low-cost manufacturing location. That is actually moving to places like Vietnam and Indonesia,
Sure,
where the costs are lower. Actually, wage rates in China are going up like 10-15% a year.
Right.
And the people are becoming a lot more prosperous there, even though, as I say, they're only making on average about a seventh of what we make on average in the United States.
So let me just take a shot at oversimplified economics here. Okay, so we buy a lot of goods from China. Chinese workers start to increase their wages and do better. They have a demand and a need for higher end things like equipment for the hospitals, MRI machines, etc., which come from here. So their growth feeds on our growth, feeds on their growth, and we grow together.
That's right, and I think we'll see a lot more consumption in China, and as a result, a growing opportunity for U.S. companies.
Fantastic. So the companies that figure that dimension out, how are we going to leverage some of that increasing demand in China, could do exceptionally well in that environment.
That's right.
Okay. Very good.
Well, Scott, okay, we're hearing all this today. What can the average person, if they can, a lot of people can barely decide which fund to invest their 401k in. What can they do with what we're talking about today to help them save and build themselves a nest egg? What can they do?
Right. Well, the first thing that I'm gonna talk about is, there are so many different ways that someone can go about building their financial architecture. But I'm going to talk about the first one is what not to do, because we are in that period of open enrollment where people are signing up, for their benefits, and that's usually when people sit down and also look at their 401ks. Often they don't have to, but they do. And so here's what happens. They sit down and they get a sheet and it says, here's the performance of these funds that over this last year. And they look at it because our brains are wired to do this, and they say, oh gosh, this fund did 18%, mine only did 2%. I think I'm going to put more in the fund that did 18%. That's almost always the wrong way to go about it, because very rarely does that high performer, and Russ just made the point here earlier, is the small and mid-cap companies in the U.S. have gotten to be a little bit more expensive. They've had a really, really good run, and if you looked at their past performance, you'd say, well, why don't I put more there? Where in fact what Russ is saying is that the better opportunities might be in some of the larger cap funds that really have a slightly more discounted view, at least if you're looking at price earnings.
That's right.
Okay, so that would be the first thing in terms of if you're going to start to do that. But the most important thing is to get a good and broad-based asset allocation. We've been talking about China. I hear people all the time talking about gold as an example. Where people get themselves in financial ruin is when they go after a big hit. They put too many chips on one square. And that is almost always a disaster. So good broad-based allocation. And honestly, I have to tell you, people don't pay good attention to their investments. And so I'm a real advocate of two things. Russ, your team runs these asset allocation funds.
That's right.
Where you guys make the adjustments inside the fund, kind of what I call trim tab adjustments, not wholesale adjustments where you're necessarily selling out of mid-caps, to your example, but where we
might reduce it a little bit. I mean, one is that we are constantly keeping them balanced properly, and then we lean against the things that look expensive and lean into the things that look less expensive.
And here's the wonderful thing. Because of economies of scale, you can get people like Russ and his team to make those adjustments for the average investor inside of a fund, because these funds are pooled to be, actually quite large. So you get that kind of benefit. And I think people should take advantage of those. In the other thing, of course, is build defense. I got to just relay a couple of quick comments from this week, because, very frankly, if you go back 4 or 5 weeks ago and the markets were in pretty big trouble, frankly, in terms of the volatility, people are like, oh my gosh, here we go again. And they started thinking about defense in the portfolio. The best time to think about defense is not when the market is down. It's when the market has recovered to some degree and is stronger. So I encourage people to start talking about that now with their financial advisor. Give us a call, get a free consultation. And oh, by the way, we've got some seminars coming up. If you want to get some more information, go to that Thrivent.com. Find an event, see if there's one nearby for you, or you can, and on that site, if you want, you can register for one of my seminars. I've got one on November the 1st. It's a Tuesday at Fong's Restaurant in Prior Lake. You can register right online there, or you can give us a call at that number, and the number, of course, is 1-855-346-4332, and for that you can get today's free brochure, which is Managing Your Retirement Savings to Provide a Lifetime of Income, or you can tell us you want to come to the seminar. Otherwise, go to that website that I've been describing here. Russ, thank you so much for being with us here today, sharing your expertise as well as your recent experience in China.
Thank you for having me. I appreciate it.
That'll do it for Financial Strategies for this week. We'll be back next week.
We hope you've enjoyed the past hour of Financial Strategies with Scott Wardell. While various products may be discussed during the course of this program, please note that these discussions are intended only to educate you about financial topics. They are broad in scope and do not consider your individual personal financial situation. You should work with a qualified financial professional in collaboration with your attorney and tax advisor before implementing any financial decisions which will affect your personal financial situation. Thrivent financial representatives cannot provide legal or tax advice. Your local Thrivent representatives are Wayne Grunkley and Alan Sogstead, 215 Atlantic Avenue, Morris. Call 589-1731. Join us again next week for Financial Strategies with Scott Wardell on KMRS Morris.